Thank you, sir. So the first question is, what is estate planning? And I'll start that off by asking all of you, where does wealth go? Wealth and property. It only goes to 4 places. David Yost, if you can tell me of the 5th, I would appreciate it. But it only goes to 4 places. 1 is maintaining your personal lifestyle. 2 is family or friends. 3 is charity community. And 4 is creditors, primarily taxing authorities, but there's other types of creditors. And so my job is to advise clients with the acquisition, maintenance, and transfer of wealth. And typically the transfer of property and wealth is to family and friends and charity. Most individuals avoid transferring wealth to creditors and to taxing authorities if they can. And so a lot of the planning we will do is both during lifetime and at death, testamentary planning with respect to maximizing the amount that will pass to family and friends and charity. So what this means is, of course, we're going to reduce the amount that passes to creditors both during lifetime and at death. Probate. That word has a lot of bad connotations. It's very simple in Texas. It's a very simple process. And it's basically filing a will with the court of appropriate jurisdiction, typically a probate court in the larger counties in Texas, and going down to the courthouse for a 5-minute, 10-minute hearing. And at the end of that hearing, the judge will say, this is the last will and testament of John Jones or Betty Sue. And as a result, what that does is it validates the beneficiaries under the will. So we now know who should receive the property. And 2, it provides a link in the chain of title for transferring those assets. So you can go to the bank, brokerage house, or on a deed for real estate, designate who should be the beneficiary of the asset. What is an estate? And we'll dive into the weeds here in a little bit, but just a few basic terms. A probate estate is basically what you own, and that is in your name that passes under your will. Your house, your personal property, financial accounts. Non-probate assets are typically those designated by beneficiary designation, life insurance, IRAs, retirement accounts. Gross estate, taxable estate, it's an estate tax term. Let's talk a little bit about estate taxes. And the gross estate is basically all of your assets. The estate taxes are a tax on your net worth. The estate tax return, Form 706, is nothing more than a glorified balance sheet. And so what you do is you add up all your assets at death, subtract liabilities and some expenses, and what is the result is called a taxable estate, and that's what's subject to potentially estate tax. Well, part of your estate, if you're married, is community property or separate property. Because when a marriage terminates by one of the 2 Ds, death or divorce, the community estate is divided. And so the question is, what is separate property and what is community property of a married couple? And for most married couples, everything's going to be community. Everything is community property. And in fact, that's where we start in the state of Texas. If you're married and there's a termination of that marriage, either through death or divorce, the presumption is, the starting point is that it's all community property. Is this mic cutting out? Yes. So, and community property is defined in the negative. And so what is separate property is what you received, what you brought into the marriage, or 2, what you received during the marriage by gift, descent, or devise, by inheritance. So unless you can trace back an asset to what you brought into the marriage or what you received during the marriage by gift or inheritance, it's going to be deemed community property. And that is very much of a shock to folks who come to Texas, and also to some people who've been living here for a bunch of years, because community property, for example, is income from your separate property or income from wages, salary, compensation. Inception of title. Let's talk about the community property presumption. We did that already. That is the starting point. Everything is deemed to be community property. So if a couple has a $10 million, $20 million, $50 million estate, it's going to be deemed to be community property unless you can prove by clear and convincing evidence that it's separate. Well, I have clients that go out and they put the assets in their name. They'll have an account with David Yost that it's in the account's wife's name is her separate property, or it's in the husband's name is his separate property, and the titling of the asset doesn't make it separate property. What makes it separate property is if you have a postnuptial agreement or a prenuptial agreement, or if in fact it was received before marriage. Okay, let's talk about reasons to have a will. There's only 2 reasons to have a will, maybe 2.5. One is to designate who the beneficiary is and how much that beneficiary receives, or beneficiaries. That's the first reason. We'll talk about some of the detail in just a second. The second reason is to designate who is in charge. Other than that, you really don't need a will. But everybody needs a will because they want to say who receives the assets and how much. And then also who is in charge. More specifically with the beneficiary, as you can see, if you need to create a trust, and you would create a trust, one, to avoid a court-created guardianship for minor children. Minor children cannot own assets. So if a minor child received $1 million and it was at a brokerage house, that minor child would not be able to sign off on transfers of those assets. So you'd have to go to the courthouse and get a guardianship. So you avoid that by creating a testamentary trust. You'd also use a trust to control the management and distribution of those assets to other types of beneficiaries who may not spend the money appropriately, such as young adults. You can also provide creditor protection to a beneficiary. If they're in a rocky marriage, you can put it in a trust, and then that inheritance won't be subject to division if that child beneficiary's marriage comes to an end. And you can use trust to avoid or minimize federal estate taxes. The other reason to use testamentary trust is to provide for charitable gifts at death. Let's talk about designating who is in charge. Depending upon the facts and circumstances, you may have 3 individuals that are designated in your will or revocable trust. One is an executor. That's the person in charge of the estate. 2 is the trustee. If you create a testamentary trust, then you'll have a trustee. And if you have minor children, you would designate a guardian as to who would provide for the day-to-day care of those minor children. Let's talk about the estate tax and the estate tax exemption. In 2022, the estate tax exemption is $12,060,000. For a married couple, it's $24,120,000. What that means is if you have an estate and it's less than those amounts as a single person or married couple, there will not be any estate tax. And we'll run through an example in a moment. If the estate is over those amounts, $12,060,000 for a married couple, or for an individual, thank you. If the estate is over the estate tax exemption, let's assume an individual single person, $12,060,000, and that excess passes to a family member other than a spouse, then there will be estate tax. Of note is on January 1st of 2026, the estate tax exemption is scheduled to go down. There's been lots of discussion in the various in the media about the reduction of the estate tax exemption. By operation of law, it will be cut in half on January 1st of 2026. Many of my clients are anticipating that to occur because when was the last time you saw Congress agree on anything? It's been a while. And so they would have to agree to, both the Democrats and Republicans would have to agree for this change not to occur. And so we'll talk a little bit about this as far as lifetime planning in just a moment. Let's talk about the marital deduction. Warren Buffett, last time I checked, which was yesterday, has an estimated net worth of 125 B for billion. $125 billion. If Warren left his entire estate to Mrs. Buffett, and there is a Mrs. Buffett, there would be no estate tax. Well, Keith, you just told me that the exemption was $24,120,000 for a married couple. 125 billion is a lot more than that number. Why is there no tax? And it's because of the marital deduction. And the marital deduction is unlimited, and basically any amounts you leave your spouse is not subject to estate tax. None whatsoever. However, it's simply a deferral device. Whether you leave it to your wife or you leave it in a trust for the benefit of your wife or husband, upon the death of the surviving spouse, there is estate tax. So at the death of Mrs. Buffett, assuming she survives Warren, the estate tax on that $125 billion would be $50 billion to the federal government. 40% of that, rounded. So, if you'll look, this is very small print. It is in your handout, and it is page 5 of the handout. And I'll make reference to this. This is John and Jane Johnson. They have an estate of $10 million. One, is that below or above the estate tax exemption? Below. So, John leaves his, the first thing that happens, because there is no prenuptial or postnuptial agreement, all of the property is community property. And the first thing that happens upon the termination of a marriage is what? The community estate splits. And so Jane, John's the first to pass, receives her $5 million by operation of law. That's just hers. She owns it. John's estate consequently is $5 million. It passes either outright to Jane or to a marital trust. And as a result, at Jane's subsequent death, it all passes to trust for the two children, Jason and Jessica, and the IRS receives nothing. Why? Because it's below the estate tax exemption. Let's talk about coordinating the estate tax exemption with the marital deduction. And if you have a taxable estate that's in excess of the $24,120,000 for a married couple, what you'll do is you'll divide the estate. The will or the revocable trust should divide the estate into two parts. Part one is the estate tax exemption, and that will pass to a trust often called a credit shelter trust, bypass trust, or family trust. Part two passes to a trust either outright to the surviving spouse or to a trust called a Q-tip trust, both of which Part 2 will qualify for the marital deduction. Let's look at an example. And this is on page 9 of the handout. A little bit more complicated, a few more arrows, but still fairly simple. First thing that happens with John and Jane upon John's death, half the estate goes to Jane because it's hers. She owns it. It's her half of the community estate. $15 million. John's estate consequently is $15 million. Is that over the estate tax exemption? It is. John's revocable trust provides for $12,060,000 to pass into a family exempt trust. As you can see out here, that trust is for the benefit of Jane and the children, income and principal for health, education, maintenance, and support. And Jane has the power to direct it at her death to the Jason and Jessica as she sees fit. The balance of John's estate, $2,940,000, goes to a marital non-exempt trust. And then you have the Jane having her $15 million outright. Total of these three boxes is $30 million. The question I have is, why isn't the IRS at this level after John's death? And the reason is the amount going into the family exempt trust is protected by the estate tax exemption. The amount going to the marital non-exempt trust is protected by the marital deduction. No tax at John's death. But as we talked about, it's simply deferral. At Jane's subsequent death, you're going to have tax on the amount, because the amount that's in the marital non-exempt trust and the amount that is owned by Jane individually is in excess of the $12,160,000, and so I have estate taxes at that point in time of $2,352,000, meaning that the amounts passing to trust for Jason and Jessica and both exempt and non-exempt are set forth here. $12,060,000 each, or $1,764,000. And as you were to get into if you were sitting down talking to the planner, you would walk through these terms here as far as what should be the terms of the trust for the children. And those vary depending upon each family situation. You got great kids, maybe you have all of these provisions. If you have kids that have special needs or have substance abuse issues, these provisions would be tighter. But this would be a typical plan for somebody who has a taxable estate. Well, we talked about the marital deduction and it being 100% free of tax. But the catch with the marital deduction is that it is subject to estate tax at the death of the surviving spouse. The charitable gifts, however, to the Catholic Foundation or to a donor-advised fund at the Catholic Foundation, being an example, would qualify for a charitable deduction, and 100% of that is tax-free. So it isn't taxed at a later date, and if you leave that amount to a qualified charity, it's 100% deductible and no estate tax is paid on that. As you can see at the bottom of the slide, you can have it pass outright to a public charity or private foundation, a donor-advised fund, and I have many clients that are using donor-advised funds now as opposed to private foundations. Private foundations, I think we have an expert in our midst, David, could give us a summary of those at perhaps the next luncheon. But private foundation, you're more than just trying to push work your way, sir. But at one point in time, we did a lot of private foundations for folks who are going to make gifts of $5 to $10 million, and they wanted to control the disposition of the assets, but not make that decision now. And now, what is your rule of thumb for a private foundation as far as dollar amount?
It's definitely gone up. I'd say at least $5 million. At
least, yeah. I tell my clients, unless you're going to put $10 million or more in a private foundation, don't go there. There's really two reasons well, there's three reasons. Let's talk about the two that matter, and then the third reason that a lot of people do private foundations. The first reason that you do a private foundation is if you want to make grants to individuals. So I want to perhaps provide scholarships to children at a Dallas Independent School District, and so you want to set that up. The only way you can do that is through a private foundation, and you have to have special qualification of the private foundation and permission from the IRS. But that's reason number one. Reason number two is if you have special types of assets that would not go into a donor-advised fund. Family has certain type of wealth that they build in a privately held company, then you have to deal with all the excise tax rules, and it gets very, very complicated. But that's the other reason. Special types of assets, maybe a business interest, maybe real estate, or you believe that your acumen, investment acumen, is better than what you'd find at a financial advisor, and you want to keep it in-house. So that's the second reason. David, what's the third reason?
Ego?
Ego, that's right. I've got the Novick Family Foundation, and I am so important I can tell all my friends at the cocktail party that I haven't. Yes, ego is the third reason, and I try to dissuade my clients because the cost of these, while not off the charts, is still fairly significant. And if you can get by with a donor-advised fund, I would recommend that to you.
Maybe Exhibit A from Trump Foundation.
Exactly.
Well, like, correct.
But that may be a political comment, so I don't know if I'm going to.
No, it's an illustration of ego and also what can happen.
Exactly. So, talked about a donor-advised fund. That's basically a separate fund at a qualified charity or a financial institution. They're called the supporting organization, sponsoring organization. And once you make the contribution to that donor advised fund, the financial institution or the charity owns the money, but yet there's advisory privileges with respect to that fund. Yes, sir?
What's the difference between a donor advised fund and an advised and consult?
Nothing.
Okay, I thought they were the same.
Now, advise and consult is probably more in the donor advised fund in terms of lingo.
Okay. We need to get you a mic.
Thanks again.
So, as we note here, the donor or a representative of the donor, in most donor advised funds, I know the Catholic Foundation does, allows you to kind of set up a successor to the donor. I make a large contribution to a donor advised fund and I can name my successor if I'm not serving. And so it can be a child or children or some sort of committee. But they retain the right to designate how the money goes, where the money out of that fund goes. So you make the contribution this year to the donor advised fund, it qualifies for a charitable deduction, 100%. It's a public charity. You may not direct the monies to your school, your church, your synagogue till next year, but you get the 100% charitable deduction this year for income tax purposes. And if, as the topic of this meeting, it's used for estate tax purposes for a distribution at death, you get 100% deduction for estate tax. So, let's talk about a gift to child or charity. We got Charlie Connor, age 75. He's a widower, has an estate of $22,060,000. Charlie has one child, Charlotte. And Charlie's will is really simple. He passes away on March 1st, 2022. His will revocable trust provides for his estate to pass to all of it to pass to Charlotte. And so what that means is his estate, $22,060,000 less the amount of the estate tax exemption. I have $10 million over that, over the exemption. The math is pretty easy. 40% of $10 million is $4 million to the IRS. So Charlotte ends up receiving $18,060,000, which is basically the $22,060,000 less the $4 million. Now, at the bottom of your page, and this is on page 14, I believe. You'll note at the bottom that if Charlie, if his will, if he had seen me, I would say, well, think about this, Charlie. Do you want the $10 million excess, if you're philanthropic, which he is, you could give that to charity and to your donor advised fund, and you would have zero tax, as noted here, because it's 100% deductible. Zero tax. That would mean that Charlotte, however, would receive only $12,060,000 and not the $18,060,000 or $6 million less. And so Charlie may say, if I talk to him, he might say, that sure makes sense, or let's give some of it to charity and I'll cut down my estate tax bill. But 100% of what Charlie left or would leave to a charity, the Catholic Foundation, is completely free of estate tax. Okay. Any questions? But Charlie asked me during the meeting, isn't there a middle path? Can we do something else? I want to provide for the Catholic Foundation, but I also want to make certain that Charlotte gets some of the amounts that go to the Catholic Foundation. And so I start talking to Charlie about charitable lead trust. And we get pretty complicated here very quickly. But a charitable lead trust is where the lead interest of a trust, well, let me back up. Trusts basically have a income interest and a remainder interest. And so you have current beneficiaries and remainder beneficiaries. And typically, the current beneficiary can be all the income, or it can be like an annuity, or it can be a uni-trust interest. And so with a charitable lead trust, the lead interest goes to charity, hence the name. charitable lead. That means the charity gets the present interest or the current interest. And the remainder interest passes to a non-charitable beneficiary, such as Charlotte. And so I talked to Charlie, and I tell him that we have two types of charitable lead trust: a charitable lead annuity trust or a charitable lead uni trust. And estate planners are notorious for acronyms, so we call those CLATs and CLUTs. And in essence, if you take one thing away on the charitable lead trust, it's that the charitable deduction is the present value of what the charity is receiving, which is the upfront interest. So let's look at it, and we can dive into some of the details. The CLAT, Charitable Lead Annuity Trust, is basically an annuity. You multiply the fair market value of the assets as determined on that very first day of the trust by a certain percentage, and that's the amount that every year the charity will receive. A charitable lead uni trust is where the percentage is times the value of the assets determined annually. So I've got to go through a valuation every year that the CLUT is in existence. And you can see here how it can be paid out over a period of time, or lives of individuals, or over an individual's life plus a term of years. Let's go back to my situation with Charlie. So Charlie has that $22,060,000 estate, but we talked Charlie into providing for the estate tax exemption to pass to Charlotte. That's the same as it was in the simple will, right, Matt? I think exactly the same. We have the balance of his trust, though, as opposed to going to Charlotte or going outright to the Catholic Foundation. He provides for it to go into a charitable lead annuity trust, a CLAT. And that CLAT provides that for 20 years, his donor advised fund annually is going to receive an annuity amount. And that annuity amount is the amount needed to produce a charitable deduction of $10 million. Why $10 million? Because that's what's subject to tax. And when you do the actuarial calculations, that annual annuity is $588,215 per year. And at the end of 20 years, whatever's left in the CLAT will pass to Charlotte. Let's look at the math. Again, we start off with $22,060,000. We take off the estate tax exemption, $12,060,000, have that same excess that produced either an estate tax of $4 million or produced a zero estate tax if it went to the Catholic Foundation. But I still show a $10 million exemption. How is that? Well, that's because the Catholic Foundation, the donor advised fund, received $588,215 for 20 years. Here's the total, $11,006,000 and change, $11,007,000. And basically, that $11,007,000, the present value of that number equals the $10 million charitable deduction. So I paid no estate tax, and at the end of 20 years, if the CLAT grows at 4%, Charlotte gets $4.3 million. If the CLAT assets grow at 6%, she'll receive $10.4. So there's my middle path. As opposed to all or nothing to Charlotte or to the charity, now I have where both Charlotte gets her estate tax exemption, but they both get benefit from the excess $10 million. Questions? Yes, sir.
Charlotte doesn't pay any taxes?
Charlotte pays no tax. Any other questions? Okay. Let's go to the flip side of a charitable lead annuity trust. Charitable remainder trust. Well, what is that? It's just the reverse. Here, the remainder interest passes to a charity as opposed to Charlotte. So when is the charity going to get the assets out of the trust? At some point in the future. Okay, so let's think about that. If I have the donor advised fund receiving the assets today and then for 20 years or 19 more years, they're going to be involved in the trust from the get-go, and they're going to kind of look after what's going on, what that trustee of that trust is doing, how he's managing it, is he taking care of the monies, is he giving me the amount that I need to the charity. When the charitable remainder trust, that trust interest is, say, 20 years out or at the end of somebody's lifetime, that means that the charity's not involved till the very end. So which one do you think is more complicated or has more controls? The charitable remainder trust, because there's more of a period of time that bad things could go on. Now, the rules don't say that, but the rules for charitable remainder trust are more complicated. You again have the same type of trust, a charitable remainder annuity trust, a CRAT, or a charitable remainder unity trust, a CRUT. And as we talked about with the charitable lead trust, here the charitable deduction is equal to the remainder interest that the charity receives, the present value. And I'll leave to your reading the rules that are on page 20, but this is more complicated because there's minimums and maximums of what that payout has to be. At least 5% or more, but it can't be more than 50%. And that's for both the CLAT or the CRAT and the CRUT. And then there's also the requirement that there has to be a minimum of 10% remainder for the charity. You can't have the remainder equal 10 million. If I was going to give that to charity and the amount going in was 10 million, the maximum amount of the charitable deduction would be 90% of 10 million, and 90% of 10 million, of course, is 9. Let's look at an example. Back to Charlie. Here it's the same as it was with the charitable lead annuity trust. I have the estate tax exemption passing to Charlotte because less any taxes that might be incurred. The balance goes to a charitable remainder annuity trust. Charlotte gets an annual payments for 20 years. Charlotte receives the upfront as opposed to the donor advised fund receiving those amounts. Charlotte gets it for 20 years. The amount of the annual payment to produce the maximum charitable deduction is $529,393, and what that results in those 20 annual payments equals $9 million present value. Let's look at the numbers. We've seen these before. $22,060,000 less the estate tax exemption, excess of $10 million. Here the charitable deduction is limited to $9 million because of the limitations of the charitable remainder annuity trust. That means I have potential estate tax of $400,000. But remember, when it went all outright to Charlotte, the tax was $4 million. So here it's down to $400,000. So the amount that Charlotte nets is $11,660,000. The amount that goes to the charitable remainder annuity trust is $10 million, and Charlotte receives $529,393 for 20 years each year. Here's the total, $10,500 that passes to Charlotte. And basically, if the trust grows at 4%, here's the amount that passes to the donor advised fund. And if it grows at 6%, the amount going to the donor advised fund is $12,500,000, almost $12,600,000. Questions? Just the opposite, the flip of the charitable lead trust with a few more limitations. And it's kind of the middle path from either nothing to charity or outright to charity.
So Charlotte's payment, annual payment, has nothing to do with the lump sum she's getting at the top, the front end?
Correct. This amount here, Charlie's estate, great question. Charlie's estate is $12,060,000. He is leaving to Charlotte $12,060,000 or $22,060,000. He's leaving to Charlotte $12,060,000 less any estate tax, and so the amount that Charlotte gets in 2022 at the point in time of Charlie's death is $11,660,000. And then the annual payment is coming from the charitable remainder annuity trust, and she receives that every year for 20 years. And so I basically, by giving the $10 million to the charitable remainder annuity trust, I reduced the estate taxes from $4 million to $400,000, and Charlotte is still going to receive $10,587,000. It's just going to be over a 20-year period. So for somebody who's charitably inclined, this is a fantastic way to provide for charity, but still provide for the children.
And then all those payments to Charlotte, that's what income to her? That is income to her, the 529 annually?
The 529 annually to her, we're talking, we have two different types of taxes. We have estate tax, and then we have income tax. Because we live in these United States, the privilege of that is everybody pays income tax.
And so that is income.
It will be income to her, but how it will be taxed, and now we really are getting into the weeds, it's a tiering process. So the first income is maybe ordinary income, and then there's capital gain income, and then there's, so if it doesn't have any ordinary income and it's only capital gain income, it would be taxed, or it could be return of capital.
Is that the same tax treatment in the charitable league scenario? The lump sum she gets at the end of that term, what's the tax treatment?
Let's go back to this. So right there.
Yep.
So tell me your specific question.
Yes, so she receives, that.
This amount here.
Yep.
That will pour out to her. Those are just the remaining assets of the trust.
Correct.
And at her, she'll just take those assets with carryover basis. No taxable event upon determination. Now, if there's a low basis, then, and she sells the assets, she has potential gain, as you well know. So, good question. I thought I saw another hand. Okay. Okay. Okay, charitable lead trust, just in summary. It's basically the lead interest goes to charity, the remainder interest passes to a family member or friend, and sometimes back to the grantor if it's done during their lifetime. And in summary, the charitable deduction is the present value of whatever the charity's getting. And basically, figure out that string of payments, do a present value calculation with the IRS assumptions, and you come up with the amount of the deduction. Charitable remainder trust, the exact opposite. The charity gets the remainder, and Charlotte, in our example, receives the payments for 20 years. And the value of the deduction that you get to take on your estate tax return is the present value of the remainder interest passing to charity as projected out. And basically it's kind of a middle path between no gift to charity or 100% to charity. How are we doing on time, Cheryl?
120.
And our official stopping time, Matt?
1:30.
1:30? I'll stop at 1:30 and, so we've got 10 minutes? Okay, I'll stop at 1:30 and open it up for a few questions if there are any. Let's talk about the gift tax annual exclusion. Mentioned this earlier, that the estate tax exemption is going to be cut in half on January 1 of 2026. And people are already starting planning. And if this is something that you do, or that you may need, do not wait till November of 2025. You don't have to call me, call someone. Call them now, call them next year. If you've not used up your exemption and you're thinking about doing it, start the process now, because it takes a while. Because I shut my practice down last November 15th because we had a big year-end rush because we thought it was going to go away last year until Congress came out, I think it was the 29th or the 19th, and said we're not making any changes. But we were working 300-hour months in September, October, and part of November. So do not wait till the last moment. Annual exclusion, $16,000, $32,000 for husband and wife. If you make a gift of the annual exclusion, no gift tax due, no reporting to the IRS. Gift tax exemption, $12,060,000. That number should start to look familiar. $24,120,000 for a married couple. Can give away that amount of wealth and not pay any gift tax. If it's greater than the annual exclusion, but less than the gift tax exemption, you have to file a gift tax return, but there's no tax due, but you have to report it. If it's greater than the gift tax exemption, you have to file the gift tax return, and you then have the privilege of paying tax, gift tax. Again, as we talked about, it's set to be cut in half on January 1st, 2026, and this applies to the gift tax exemption. So what are people doing? They're making the gift now and capturing it so the IRS can't take it away from them. Let's talk about the use, just to highlight how it works. Donor makes a gift of $250,000 to a family member. He's required to file a gift tax return because it's greater than the annual exclusion, and he has to allocate $234,000 of his exemption to that gift because only $16,000 is covered by the exemption. No gift tax is due, but there is a requirement to file a gift tax return, and the exemption is thereafter reduced. His exemption going forward is only $11,826,000, and if he had previously used up all of his exemption, he had given away the entire $12,060,000, that $250,000 gift would produce gift tax of $93,600. That's the 250 minus the 16, the 234 times 40%. Generation skipping tax, we're going to move that. What time is it, Cheryl?
It is 1:24.
Okay. Okay, let's talk about just a couple global concepts. The planning process. I tell my clients that there's two phases to the estate planning process. And those are phase 1 and phase 2. Sounds pretty complicated, doesn't it? Phase 1 is what I call testamentary planning and disability planning. And phase 2 is lifetime planning. Now, in the estate planning literature, is there anything such as phase 1 or phase 2? The answer is no. But I try to have my clients do phase 1 first and phase 2 second, and here's why. Everything that's on this screen for phase 1 is revocable and amendable. Nothing that's on this screen can't be changed. And a lot of the concepts that you will use when you get to phase 2 for trusts that are tax effective, charitable remainder trust or spousal lifetime access trust, a lot of those, almost all of those techniques are irrevocable and unamendable. So I like to have my clients get comfortable with the concepts before signing documents that are irrevocable and unamendable. And the other concept to take away from this screen is that what should drive the planning is your counsel talking to you about what are the goals that you have as far as where do you want your wealth to go. And so basically that is what you figure out. Basically point A, that's where you are today from a family standpoint, a financial standpoint, and a document standpoint. You should determine where that is. The question is, where do you want to be as far as your children or charities? That's point B. And the job of the trust and estates lawyer is simply to get you from A to B. Now that can be very complicated or it can be quite simple. Let's fast forward. Lifetime planning. Okay. There's a bunch of files or pages after page 31 and 32, but we're just going to talk about 31, 32, and then I'm going to say thank you. Page 31, what is the estate tax? It is nothing more than a tax on your net worth subject to adjustments. It's basically all of the assets that you own or can control, and life insurance that you own that is in your name and that you own the policy. So there's a gazillion techniques without going into them. There's spousal lifetime access trust, multi-generation dynasty trust, grantor retained annuity trust, elder defective grantor trust. Robert, you've seen all of these, have you not? And then you have all the charitable planning, charitable remainder trust. All of these techniques do one of two things to reduce estate taxes, and that's it. They either remove the asset from your balance sheet, or they reduce the value of that asset, either by valuation discounts or actuarial discounts. So, that always gets me to the question, which I had over and over again last year when we thought the exemption was going to go down, is how much do I give away? I've got a $50 million estate, how much of it should I give away? Should I give my entire $24,120,000 of exemption that me and my wife have, or do I make a smaller amount? And that conversation is, I say, that's above my pay grade. You need to talk to David and Robert, your financial advisor, and figure out what that amount is, because that's above my pay grade. But what I do know, and it's where we started off with this conversation, Steve, wealth goes one of four places: maintaining your personal lifestyle, family and friends, charity, or creditors, typically taxing authorities. And the first place that that wealth needs to go to, always, is maintaining your personal lifestyle. So I say it's the golden rule. He with the gold rules. And you decide how much to give away. But you can go through that process and objectively get close to it. And that's what I say here. You make an objective analysis of your net worth, how much can you give away? And then the second point, once you determine that excess wealth, you determine what do you want to give away. The first question is how much can you give away? And the second question is what do you want to give away? I've got a client with a $100 million estate. He can't give $1 of it away because he needs every penny of income off that to live. He lives rather large. I got other clients who last year had estates of $30 million and they gave away the entire $24 million because they just don't need it. So the first determination for those of you who might be doing gift planning is what is the amount of your excess wealth, because then that is a subject, potential candidate for giving, either to family or friends or to a great institution such as the Catholic Foundation. Thank you.